This conference will now be recorded.
All right, guys, so welcome to this edition of Traders Exchange. As always, everything that we're going to be talking about today is for educational purposes only, and nothing is intended as any type of investment advice. All right, so based off of just a really great morning. I mean, a little bit slow and a little bit slower developing, but we've been just continuously seeing that. And actually, the first question that we have is going to kind of fall into that category. But one thing that I do want to bring up is this is UONE, just absolutely incredible. Unfortunately, once you did get into it, you really didn't get to trade for more than like 10 seconds at a time. But what an amazing move. You're talking about over $13 coming up to that top, and then it finally gave some time to sell off, and then we ended up seeing that huge move towards that downside. So we're going to be using this as an example in a few different things, just to talk about personalities and things of that nature. But let's get right into our questions, because we do have a lot of them. I'm going to start with the questions that we did not get to from last week. So the first thing is, how can I set smarter stop losses? I find my trades doing exactly what I expected them to do, but first hitting my stop loss and shaking me before making the actual move. So there's a few things that goes into this. Now, the first thing is, what is our ratio? Okay, there's the certain parts of a trade. Now, the most important part of taking a trade is having the game plan set up before we really even get into the actual trade. So everyone always thinks about entry first. Entry, entry, entry. And of course, the entry is very important, but the best traders in the world are always going to have the first thing come into mind is, how much am I willing to lose on this actual trade? So in order to know how much we're willing to lose, okay, what's the most important part of our game plan? What tells us how much we're willing to lose? Because as Oscar just said, 1 to 4, 1 to 5. And basically what that means is, for every dollar, we should be willing to lose between 20 and 25 cents. And like David just said, price target. Price target is the number one thing that we have to focus on in order to kind of set up the rest of our game plan. All right, I'm going to actually use Oxy for this example, because Oxy was just absolutely a textbook trade. And you know what? The trade was way bigger, but the beginning of the morning, it just did exactly what we saw. You're talking about only a dollar move, but only a dollar move for our first, for our first trade of the morning. You really cannot go wrong with that. So let's talk about Oxy. So when we first started this morning, we knew coming up to that 21 level that we had ask prints there. And we also know that we had our orb and our very strong support line sitting here at 2050. So in this case, what we're going to be looking for is a 2050 price target. So what that's telling us is that from above the 21, wherever that trigger came in, essentially, how much are we able to lose? So we have to start off first understanding exactly how much we're willing to lose in a trade that you're talking about at 70 cents coming from the pre-market. So how much could we lose in that scenario, having a price target of 2050 that we had in our morning meeting? So right here, how much are we willing to lose? Because we can see our trigger kind of started right here about 2010, give or take. So we're talking about 60 cents. Okay, 60 cents, how much can we lose? Now forget it, make it even easier. So let's just talk about 50 cents. Okay, so basically we're talking about 10 to 12 and a half cents. Okay, that's how much we could possibly lose in that scenario. So what we have to do is, we have to set our stop wherever we take our trigger, wherever our trigger starts from. That's the amount that we have to get out for. So that's the simple part. Okay, that's basically telling us that, giving us a good risk to reward ratio. So the biggest thing is, it's not much about your stop loss if you keep getting shaken out, because we've all been there. Every trader's been there, where a stock comes back that shakes us out, and then it does exactly what we were expecting it to. That's just part of the process of learning how to trade. So what's really the issue here? Is it stop losses, or is it something else? What's the actual issue if we keep finding this happening to ourselves? Definitely timing. Entries 100%, because it's 100. Okay, but what's the main focus? So if that keeps happening to us, what's our main focus that we have to work on within our trading? It's very, very simple. It's not simple. Yeah, triggers. triggers and understanding what the game plan of the actual trade itself is going to be. If you guys go back into the trade, the chat from this morning, you'll see as we were coming down to this 20 the second time, I said we need more selling. We need something that shows it's going to be now, because we had the selling to be able to crush this 20, which we can see we absolutely did. To be honest with you, I would have been expected a little bit more, but we have this 1905 print line that was sitting right there. Big support level coming in. So it's not necessarily your stop losses, because your stop losses have to stay consistent. All right. If you try to make up a different stop loss every single time that you have a trade, or how much you're willing to lose, and it is different every time that you're trying to set up a game plan for a trade, can you possibly be consistent? Is it going to be possible for you to be consistent if you're constantly making up a different rule for what your trading is going to be for that specific trade? And of course, it's impossible. So now that we know exactly what it is and how much we're willing to lose on our trades, we have to look at the game plan and the more now. So there's two ways of looking at that. Number one is triggers. Okay, so if you're trying to get into your trade and you're not following triggers and you're not there, that's what needs to be your main focus. Because a trigger is telling us it's the release of the stock. Remember, it's that price action and volume all at once that tells us it's not building time anymore. It's now money time. Okay, but false triggers happen all the time, don't they? We see constantly a trigger, perfect trigger that ends up coming right back. So what do we need to add? What's one thing that we can just, to make this really simple? Of course, there's, a million other things. It's basically how to trade. It's, I love when people ask me, how do you take your entry? Okay, what's an entry? Well, an entry, that's everything. That's knowing every variable that comes into trading to understand what an entry actually is. But what's the easiest way that we can just change if we're having problems with triggers and it's coming back and shaking us out more often than not? What's the easiest thing that we can change? Or add, not even change, add to what our triggers are going to be. And it has to do with print. Find something smooth, 100%. That's going to make your trading life just so much easier. But there's something that we can look for right before triggers that tells us that the trigger is going to be a higher percentage than it would be if it's just price action and volume. What is that? Volume patterns, absolutely, but that's not the easiest one. Volume patterns, so if we go into a volume value or volume dip, we know that more than likely that trigger coming out of it is going to be able to get that consistent volume to be able to sustain. That's why we look for those volume patterns. But there's one thing that if you start to pay attention to right before a trigger happens, it's going to tell you that that trigger is way higher percentage. Now prints, the shimmy definitely, but now short-term prints. So what you're going to want to do is before you're getting into a stock, you need to be able to see somebody coming in that says short term, it's time to make money right this second. When we came down to this 20 the second time, it was a perfect time to break. But guess what? How many times does a stock break under 20 and then come right back? We see it all the time. It's just a common thing because that's how they make money. They break below the 20. That basically tells retail that guess what? Now I'm safe. Okay, and then they bring it right back up to be able to take those shares that people are taking. So my biggest piece of advice and the easiest and most simplest piece of advice that I can give you is that you need to, before the stock happens, look for the reaction. Before the trigger happens, look for that reaction of short term, I need to make money prints now. Now, what do those look like? Okay, that tells us we need to look at print personality. Okay, what print personality is just very, in a nutshell, obviously, we just spent our entire last class on it. There's a lot more that goes into it, but if you really want to break it down very simply, all it is what does a typical market maker look like trading that stock? And the easiest way to go about it is just look down to the bigger time and sales, everything over 1,000. If we look at what its print personality is now, we just want to get a mental average of what a trade typically will look like from a market maker. So if we look at this right now, let's just do a real quick example. Okay, what's our print personality right now in Oxy? What is our print personality right now in Oxy? Yeah, give or take 4. Remember, if you go higher within your print personality, it's not a big deal because of the fact that's just telling you you're going to need more prints. It might take you less, you might take less trades, but at the same time, does that really matter? Because the trades that you're going to be taking are higher percentage. So what we want to do is we want to see something right in that area. We want to see something 3 to 4 that shows us that this is a market maker that needs to make money now. Because what happens if we get 10 prints that happen in Oxy? And a perfect example is the tons of selling we saw coming in at that 2050. What's going to end up happening? What does that trigger? So if we get a trigger down after that much selling, what does that typically tell us is going to end up happening? Is it time for us to actually make money yet? Or are they going to pull it back before it actually does what it needs to do? So we need those shorter term prints to come in to tell us that somebody's ready to make money now. And you're going to see if you start focusing on that, it's going to start happening less and less where you get into the stock, it shakes you out, and then does the exact same thing. So number one is that you need to know exactly what you're willing to lose based off of your price target. And then number two is that you need to start to see those shorter term prints coming in, because if you get huge selling, guys, we know that's the tip of the iceberg. So what's going to end up happening is the stock is going to end up pulling back up. So if we only get those short-term prints that come in, that's when it's telling us that that trigger is going to have a way higher percentage to really be able to make its move. Make sense? All right, and what kind of major changes are you seeing in the markets? Anything we need to be aware of with the type of tape reading methodology we have in place? Okay, so there's one thing about tape reading. When has it changed? When has tape reading changed throughout the course of time? Never. It cannot. You cannot fake buying and selling. You can show a lot of buying and even more selling. You could show more selling and even more buying. You could even show pretty much the same exact thing. But it cannot change. So that's why this methodology, I get asked this question all the time, and people say, oh, well, the quants are coming in, or the whatever, the algos are getting smarter, and they're making different types of moves. And they say, guess what? Does it matter? Guys, if there's volume, is there anything they can hide from us? I want you to understand this. If there's volume, is there anything they can hide from us? Nope, not even close. So there's no changes, guys. There's changes in patterns. And that's why I tell you guys, we talked about last week, why it's so important for you to understand your own patterns within your trading. Because, yeah, every once in a while, something new pops up. Where it pushes into a level, doesn't hit, it triggers down, really high percentage trade, and things of that nature. But the actual market itself cannot change, because what's it based off of? There's two words. What's the market based off of? Supply and demand. So can anything ever change? So yes, there's patterns that you're going to start to see. For instance, one of the patterns that we've been seeing as of recent is during the pre-market, we're getting great cheap stock trades, just very clean, happening very quickly. And just showing exactly what's going to happen. That's something that's been changing, because we haven't really had great pre-market trading, going back 6 months ago. Most of the pre-market, we were just sitting there kind of, sitting on our hands, scanning and just continuously hitting, our rapid risers or rapid gainers, continuously going over. But so that's something that's changed. But does that affect any way of how we trade? In any way whatsoever, is that going to affect how things work? That's the one great thing. So you could have the best indicator in the world. You could find this perfect, scenario of a bunch of different indicators that tell you exactly, what the stock is going to do. What's going to happen once the market makers see that works? What ends up happening? So one thing about indicators, you could have the best strategy in the world. Okay, guess what? Everyone knows, most people that have, that know about indicators, the 200 moving average. That's one of people's favorites because they think that it's a resistance point. But how many times does it just break and the numbers just change? Well, guess what? That's because market makers know how many people are out there using that specific indicator. So one day it's perfect. The next day, all of a sudden, you don't know how to trade anymore. But the thing about that, if the stock is going to break a 200 moving average, guys, are we going to get buying prints underneath it? We sure are. Are we going to get short-term buying prints underneath it? We sure are. So there's nothing, the cool part about learning how to tape read is once you understand it, it can't ever change. There's nothing else to look for besides patterns. There's nothing in the market that can do anything else, because guess what? At the end of the day, if somebody buys a lot of shares, do they have to make money? Someone buys a lot of shares, do they have to make money? Absolutely. And that can't change. Okay, if somebody is, somebody's out there and they have a position, that's why, our number one assumption is that market makers always have to make money, because they do. If they don't make money, then they're not a market maker anymore. They get fired, and someone that will make money is going to come in, and we're still going to follow them over and over and over and over again. So that's one thing that you never have to worry about. You don't have to worry about the methodology all of a sudden changing, because since 17, whatever, I forget the exact date. It's on the website somewhere, but it can't change. Supply and demand is what moves the market, and as long as we can follow, supply and demand can be hidden. There's nothing that can happen that can hide that. So that's going to tell us everything over and over again. All right, make sense? Okay. All right, moving along. So I have done fairly well across the board with anticipating what a chart would look like from the prints we get in the morning. But sometimes I will consolidate during the optimal trading hours in the morning and make its move in the afternoon when there's typically less volume. Going over classes on triggers has helped considerably already, but unless there is a brand new story coming into play or complete personality change in the stock, my trusted confidence in my expectations coming to fruition in the afternoon goes on a steep decline. Side note, this is probably because when I first started trading, I had a good day and I built the mindset of either not giving profits back or making a bad day worse by trading in a time with less volume. Okay, so what's the question? So the afternoon, let's going over classic triggers. But unless there's a brand new story coming into play, including personality change, my trust and confidence activation come to fruition. So I'm not sure what the question is here. How do well, because there's no question mark. How do I ID setups when volume isn't strong? Okay, that's there now. Okay, now we can go off of that. So the thing about when volume isn't strong is it shows so much more than it does when volume is strong. I know that's a crazy thing to think about, because when volume's huge, I want you to think about this. When volume's huge, how much weight does each print, let's say our print personality is huge, because typically with volume, really big volume, you're going to see tons of bigger prints that are coming out there. So when we really think about that, how much weight does a print hold when there's tons of them? Let's start here. How much weight does a print hold when there's tons? So they still hold weight, but not that much, because there's so many prints, each print just doesn't have as much. But then when volume is low, when we get prints, guys, what does that tell us? What does it tell us about the weight that print is? And we use, and I always go back to the same examples, because guess what? I have to use the same examples because tape reading doesn't change. So at the end of the day, once we understand this fact, it is what it is. So when we think about that, when there's lower volume and we see someone building, what does that tell us? What does that tell us? Because guess what? During lower volume times, you could have pretty much, nothing happening. And a stock might not do anything. And the perfect example, and I just changed my damn notes, so I'm going to forget every time I change paper. Yeah, let's use UONE from yesterday. So the thing about understanding prints, okay, and understanding things during a lower time is we have to understand that it might not happen. So what we need to do is we need to look for the opportunities, things that have potential. You guys hear me talk about it in the meetings all the time. And I say the stock, it's not doing anything. We end up putting it on the side list because it has a ton of potential in it, but it's not showing us anything could happen. And this was the same thing that we talked about yesterday in our afternoon meeting. All right, the stock wasn't showing anything. It was literally, look at our volume here. Okay, so it's showing us that there's absolutely nothing happening. But it's telling us that we also have that buying that was sitting over here to show us that it has the ability. Okay, and we have to start there. During lower volume things, we need to go back to when the volume was higher and people were actually trading it. So if you have a ton of buying that's, let's just say in this scenario, that came in right here, okay, and we'll go to our high first, okay, and let's just say 7, just to make easy numbers. So we have a ton of buying that came in at 7, and then the stock just falls down and does nothing. What is it going to? Now this is the anticipation part. We might be watching this all afternoon, guys, and could UONE do absolutely nothing and just continue on this low volume path and never actually make any type of move to get back up towards this buying right here? Anyone ever see that happen before? Okay, look at GNUS. Look at, it's a constant thing. So what we have to do is we have to think, what does it need to look like in order to show us that that potential is now coming to a reality? And the answer that you can always give that's never going to, it's 99.9% never going to be wrong. What is it? What's going to show us that now that potential is that it's coming? It's the volume. Because if we look over here, you can see it's starting to get a little bit, but then look at what the volume looks like as it's coming in. So it's not necessarily about losing faith in a stock, because obviously if it gets a kiss of death, that's the end. Okay, a kiss of death is basically telling us that the stock's, it's just not, it doesn't really have any type of possibility because there's nobody left that needs to make money. And if they did, they would have been getting out of the trade at that point. That's why if we look back here and this stock would have, crushed underneath and we started, we went to 1, well, guess what? There's nobody here that needs to make money anymore. So that potential is now lost. But the entire time, as we're seeing this stock in that consolidation, we have to envision and the anticipating, the part that you said you're getting better at anticipating, the anticipation part, okay, is not only what's the possibilities of its movement, but what does the volume need? What does trade, and let's not even say volume, what does trading need to then now look like to show us that the potential is actually going to hit? So your biggest thing is going to be starting to watch your volume. We talk about waxing volume all the time. Okay, has anyone ever broken it down in their mind what waxing volume really is? We know a volume bar, then a higher volume bar, then higher volume bars, and higher volume bars. We understand that. But has anyone ever broken down what waxing volume actually is from the the outlook of who's trading it? Well, what it means is that there's interest, and then there's higher trading interest, and then higher trading interest. So when we start to see that volume wax, now that tells us, all right, that the interest is getting higher and higher and higher and higher. And what happens when people start flocking towards something? If everyone starts running in one direction, okay, everyone just starts sprinting somewhere, what are other people going to start to do? Yeah, they're going to start sprinting. They don't know why, Trip. They don't know what they're running from, but it's just something that people do is they follow. Okay, it's just human nature that comes into it. So when we start to see that waxing volume come in and the stock has potential, that now tells us the trade is back in play. If we don't get that waxing volume and we don't understand what volume actually needs to look like in order for the stock to run, and it just continues in this kind of like bull, I don't want to, crappy type volume and nothing really is happening coming in, it goes back to volume patterns. Okay, the easiest way to know potential is going to come back is look at what your volume pattern should be. Look in this case right here. Okay, once the stock literally shows, we know it needs at least 120,000 to come in. And then look, once we get 120,000, it never looked back. So, to get to your question and really just to kind of put it into a nutshell is how do we ID setups when volume isn't strong is that we really can't. What we can do is we can identify potential And then from that potential, we can identify what volume needs to start to look like to show us that it has an ability to actually fulfill that potential. Because I can't tell you how many times, guys, I'll sit here and, we have a stock on our side list because I know that the thing can run big time, but it just sits there. And as it just slowly moves and slowly kind of floats around, I just keep moving my order. But I'm ready for when it looks like this, because that's the only way that a stock can reach its potential. Because you got to understand, the first time it pushes up, we're going to have great volume. We know that. Now, when volume starts to get low, what it's telling us is that they're going to be building during that lower volume time. So these prints are actually going to hold even more weight than the prints that happened in the first place. Because what's the only reason to bring down a stock that needs to go up? There's literally no other reason in the world, to accumulate. So if we see the accumulation still happening, even the buying over here, it's just the volume. That's it, and you have to be ready for it. That's why there's the stocks that have potential that are doing nothing, and then there's stocks that are actually moving that we can trade what's going on at that moment. So to be able to identify it is to understand what the volume needs to look like. Once that volume starts to fit the pattern of what it should look like to hit that potential, that's when it becomes a trade again. Until that point, this stock could have floated up to 20 yesterday. But if the volume stayed the same way like this, guys, would there ever be a trade here? So like from right in this little valley right here, if volume looked like that as it was just continuing, no trade. So really is anticipating what volume needs to look like and then identifying when it's happening. That's when our trade comes into play. But the number one part is really just understanding that the stock still has potential, because we've all been there before. Anyone ever just watch a stock for hours and know that it has print somewhere, but it just never does anything? Okay, every trader's been there. And you spend all this time waiting and waiting and waiting and waiting. But you don't need to spend that much time. It's just once it's ready to go, because we got to understand something too, is when a stock comes down to 350 and we know that the top is at a 7 and it has buying up here that needs to be satisfied to push up. Well, the only way to get to 4 to 8 is volume. Make sense? Beautiful. Moving right along. Okay. So what do you look for to know that a stock is not going to pull back before satisfying its prints? And a lesson I remember you saying, not word for word, if you see prints and immediately enter, you're going to be red. This prevents me from entering in until I see the proper pullbacks and ups, but I tend to miss moves that way. Perfect example, GNUS at the open, S prints at 5, promptly went to 550 as I sat there and watched for the pullback. Okay, so this breaks down to it's just a huge thing that we need to understand. Does every move warrant a trade? Does every move warrant us taking a trade? Not even close. So if a stock prints at 5 and then just continues to 550 and you're a level, let's say 4 trader, was there money there for you to make? And so many traders just have a very hard time understanding this. But if a stock doesn't follow exactly what your expectations are, is there any money there? See it all the time. And I'm going to tell you how you can actually see when it's not going to happen and when it's going to happen in a second. But I want you to understand something. Unless you're a 7, 8, 9 level trader, you should not be taking anything that does not fit your rules. Okay, who are the type of traders that get to take a trade that don't fit rules? Who are those type of traders? Me. Well, I don't mean, specifically, but consistent. Okay, people that have the best way the way that I always look at it is the people that have earned that ability, because they follow the rules for so long, they know when something's going to be an exception. But what a lot of people don't understand is that if you don't have a set of strict rules to follow, can you ever know what a reaction against the rules is going to be without having that foundation of watching the rules over and over again? Is that possible? Can you ever be consistent? Can you ever get to where you really need to be within trading? So I want you to understand something. When a stock prints, okay, at 5 and then does not pull back, there's no trade. So you were watching it go, but you weren't watching it as you weren't making money because there was no money for you to be able to make in that situation. Okay, knowing when something is an exception to a rule means that you know the rule inside and out. And if something is an exception, does that give us consistent profit day after day? Are we going to have consistent profits looking for a UONE? Okay, a stock that goes from 6 up to, to 1925. Is that possible? So I just want you to understand that first is that, yes, there's going to be stocks that just do what the hell they want, but that's not the stock for you. No matter, and even a way bigger point in this case is that at the open, should you be taking stocks that aren't following the rules ever for your first trade? Absolutely not. Because what's going to end up happening is you're gambling. You're taking a guess. We have a set of rules because that's what happens to the highest percentage. And then what happens is once you have those down and you understand what that stock is going to do, and that's what it is, it's FOMO. Okay, is there any place for FOMO in trading? I've said this many times before, guys. Okay, if I showed you how many moves a day you missed, your mind would just explode. Because can we trade everything? No, but what we can do is put ourselves in the highest percent chance of success by following things and finding things that are going to follow the rules the way that statistically the most stocks do, to the highest percentage. Okay, so that's just number one. Now, number two, the easiest way to see when something's going to happen is what? Okay, and the students from last class, you guys should have this answer for me right away. What's the easiest way to see a stock is not going to pull back right away? Because it always needs to. At some point, the prints always need to be satisfied. There we go, Daniel. Reaction. Reaction is the best indicator of when a stock is going to turn into an exception. Does a stock ever move without someone making money? I don't care if it's up, down, sideways, whatever. Does a stock ever move without someone making money into it? No. So now let's get into the head of a market maker. Let's just use this as an example. Let's say we get great ask prints at 14. Great ask prints at 14 tell us what? It's simple rules. If we get great ask prints at 14, what does that tell us? Pullback, but why? Remember, I need specific answers because if we know pullback, and you could be a great trader, a good trader, just saying pullback. But what's the reason behind it? What's the reason behind a pullback from great ask prints at 14? What did they tell us exactly to build? So those great ask prints at 14 told us they're looking to build. So are building prints telling us the stock is just going to start running? So answer's no, absolutely not. So if that person told us they're going to build, if the stock is going to run, let's just make up a number, let's say 16. The stock is going to run to 16. What will we see almost immediately after those ask prints at 14? What needs to be seen if the stock is going to run to 16? Because that's $2. There's no market maker in the world that's not making money on $2. So not riders. Remember, riders are the opposite. So if we had ask prints at 14, riders would be bid prints coming in after to make money on those pullbacks. But yes, we're going to see trading prints that are almost an immediate reaction. And I have been noticing that things are becoming a little bit slower. And that has to do with just the fact there's not as many market makers out there during the summertime. Trading's been great, but there's still less market makers trading right now than there would be in September, October, November, and so on and so forth. So almost immediately on those ask prints, we're going to see a reaction from trading prints for now. So you might get 14, and we talk about leaked prints. Leaked prints is a great way to look at it. You get great ask prints at 14, but the order was so big because they knew the stock was going, it leaks over to 1401, 1402, 1403. Okay, or we get that great ask burst at 14, but then immediately afterwards, above the 14 level, we're going to see prints that are coming into that stock that show us that someone's ready to make money right this second. Okay, does a short-term trader go into a stock that needs to pull back 50 cents immediately after somebody shows that they're going to build and pull the stock back 50 cents? Does that make any sense whatsoever? Think logically. If you worked at Goldman Sachs and you told your boss that, well, this is what I did. Okay, are you going to work there anymore? Nope, absolutely not. Because exactly, it doesn't make any sense. Because if you know it needs to pull back 50 cents and you're a short-term trader, well, you need a better entry. When you see short-term prints, guys, they're not building. I mean, they could be to a certain extent, but you're talking about real small increments. They might maybe 25 cents, because short-term traders still do build some pretty nice positions sometimes. But what we would need to see at that 14 in order for the stock to run to 16, someone's coming in after those prints and buying. Because you got to sit there and think for a second. So you're going to tell me that someone comes and gives building prints at 14 and then the stock just runs and no one else is going to buy after that? Anyone ever see that happen before? I mean, I'm sure, on orders or something like that, but that's not how it works. It wouldn't make any sense to make it work that way. So this is more advanced, because I'm going to tell you right now, if you're a lower level trader and you're trying to trade moves rather than trying to trade the game plan that's being told to you, you're going to fail. And it's not going to just be failing like a few cents here, a few cents there. You're going to get caught in things that are just going to screw that. You're not going to be able to control your losers. So number one is follow your rules. Just because the stock moves, it does not mean it warrants a trade. And number two is that if a stock is going to be an exception, the reaction to building prints is going to show you short term. And then what happens if it doesn't show us any of them? What happens if after the building it doesn't show any type of short-term prints, but it just keeps running? What does that now mean? What does that now mean? Well, it means there's no trade. Very simple. So definitely look for, but exactly, Eric, it's retail is driving it up. And if a market maker allows retail to drive a stock, what's going to happen? And I say this with kind of a sad voice on purpose, because it makes me sad that people don't understand this. Not the boat I want to be in. That's pretty much hits the nail on the head. It's that the ship's going down. So now, guess what? You just wait, and as far as it gets away on retail driving it up, just wait for that pullback trade, because it's going to happen. If market makers do not, there's two ways that market makers allow retail to help them. Number one is they screw their life over. When I say that, I'm not kidding. That's why there's such a huge failure rate within trading, is because market makers know exactly what retail are thinking. If they know exactly what retail are thinking, they know how to take their shares away from them. It's really, it breaks down like that. And number two, and it's not as often, that's why we see more false triggers than we see actual triggers. Because if you look at a stock and you see how many times we actually get a release for the money compared to a release that just isn't really a release, there's always going to be less real releases, because there's only, there's more building that goes on in a position than there are releases. Got to think about that. If you're building a stock, you have to build longer. The release is instant. Okay, so at the end of the day, if they let retail just take a stock, the second part, the second thing that a market maker will do is allow retail to make money on their release. Why do they do that? Why does a market maker let retail get in on their release to actually make money? Because market makers actually do want you to make money sometimes. It's not as prevalent as them taking it from you, but they want the volume to help them push it to go forward. But it all comes back to the same exact thing, guys. Are we going to see short-term prints come into that stock if a market maker wants retail to help them push it? Always. And guess what? If it doesn't happen, move on. Okay, it's just not an entry at that point. But these are the things that we have to understand. You can't trade movement. Okay, who trades movement? Who trades movement? Retail. And how's retail's record statistically since the market's been open? How's retail doing as a whole? So guess what? Don't do it. But that's kind of how it falls into those categories. Make sense, Christian? Okay. Moving along. All right. So how do we identify prints that are intended to push a stock in order for market makers to get out? More often than not, this is a common situation in cheaper stocks with 15 minutes of fame. Almost always. Okay, so just break it down. So how do we identify prints that are intended to push a stock in order for market makers to get out? It's almost always a cheaper stock. Okay, how often do they do that in Apple or Baba or Facebook or something like that, where they push a stock to actually get out of it? How often does that happen? Because once again, I can't just answer a question without giving you the psychology behind why it happens. Not often at all. Why is that? Why is that? Have to understand the psychology first before we can get into why and what it looks like. Baba will be there tomorrow, and that's it. It's because Baba will be there tomorrow. So do they have to accomplish everything instantaneously? Or will they have plenty of time to actually get out of positions or get into positions or whatever it is? But will they have the time to be able to do that? And the answer is yes, because it's still going to be there tomorrow. Okay, if a market maker knows that UONE is going to 20, and that is it, it will not go any further than that. Okay, how long do they have to get out of their position? Well, until it goes to 20. So the reason that these 15 minutes of fame type stocks, the reason that they have to push these in is because number one, okay, it might not be there tomorrow. And a lot of times, it shows us that within the prints that it's not going to be there tomorrow. Okay, but number two, what are position sizes? Let's also think about this. What do you think the position size in UONE compared to a position size in Apple looks like? Think about that. Now, of course, someone's going to tell me, oh, well, the float and, how many, what their market cap is and blah, 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 blah. I don't care. I don't care what the specific stock is. But what do the position sizes look like in a cheap stock? Are they trading, tens of thousands, hundreds of thousands, millions? Okay, a perfect stock example would be, well, I mean, this is a perfect example too, but yeah, lots more shares. Just take a look at this. You're talking about over 400 million shares traded in one day. The next day, 240 million shares traded in that day. Think about what the volume looks like compared to what it looks like on a regular stock. So understanding the fact that they have these gigantic positions, they're not small, especially when you have something that has that much volume that's going into it. So now we have to kind of understand money flow. And I know that's kind of like a taboo word here, but we have to understand what money flow starts to look like. We need to understand the person we're following. Okay, and then in a cheaper stock like that, how many market makers are going to be in a hot, cheap stock? Okay, and let's just make up a number and say on average there's 3 market makers in a stock. This is not the case because every stock is different, but let's say there's 3 market makers in there. How many market makers are going to be in a stock what's it called? Like oh my God, I'm drawing a blank. Yeah, our EL. Oh my God. Where are you? UONE. It's such a weird ticker. For some reason, my mind doesn't keep it. But how many market makers do you think are going to be in a stock like UONE? Do you think only one person's watching a stock that goes to that moves $13 in a day? Do you think if our average is 3, Would it be safe to say it's greater than 3 coming into it? 9? I don't know what the answer is. I mean, it's really it's one of those classes. We talked about last week, a class that I wouldn't take. I have no idea what the exact number of market makers that would be into it, but we can say that it's going to be greater than 3, probably greater than 4, probably greater than 5, probably greater than 6. So in a situation like this, it's so important to remember who you're actually following. So now from that's going to give us an idea of what that person's money flow looks like. Because is it possible for us to know all the money flow of all 7, 8, 9 market makers that come into a stock? Is that possible? Okay, no way. So we need to know that first person that we're looking at, that's coming in, and the actual person that we're following. Now what we have to do is we have to break down our building versus trading. What happens in a stock that's 15 minutes of fame when they release it? What happens in a 15-minute of fame stock once they release it? Are they still building? Why not? Why aren't they building anymore? Why aren't they building anymore? Well, they need to get out, but it also tells us what about how much room is left? Of course they need to get out, but they already had to build. You don't build on a 15-minute of fame stock at multiple levels. Well, no, first of all, you can, and we're going to get to that in a second, but for the most part, you build in a certain location to then release the stock because you know it doesn't have a long time to actually be there. So how do we know when a stock pops up again and is just there to get out? Well, guess what? You don't see building anymore. It's the easiest way in the world to know that that second move doesn't mean anything. For instance, okay, if we look here, as this stock was going up, yes, it was halted every 10 seconds. The prints were very hard to read, but we're going to use this as our example. Okay, as we started pulling back down here, guys, if the stock was going to go back towards this double top, would there be building here? Stock was going to go back towards this double top? Absolutely. So if we don't see building, but then it pops up again, what does that tell us? Why did it pop up? Just got to think logically. Think about the game plan behind. That's it, right there. Easiest way to know to identify that someone's going to pop the stock back up again, just to drop it on you, is the fact as when it should be building. So you got the release. Okay, the first release, great trade, beautiful. Okay, but how many of us missed the first trade and then we want to get in again? And that's typically when someone gets caught in in a market maker that's getting out, where they pop the stock back up, make it look like, you know what, it's about to run again, people get in, and then boom, they slam them out because they need to get out of their trade. So the easiest way to notice this is to make sure you're paying attention to, are they building? Because a cheap stock, guys, can a cheap stock go from $2 to 100? Now, obviously, this isn't, the most common thing, but can it? I've been in them before. Of course it can. But as the stock was going up, once those falls come in, if the fall comes in and there's no building here, the next movement, even if it's going to print, okay, tells us that they're going to be getting out and dropping shares on people. Because at the end of the day, is there ever a move that a market maker knows of that doesn't make money on it? And when I say make money, I don't mean go out there and buy 1,000 shares. That's not making money. Now, don't get me wrong, it is, but it's all, in perspective. So if a stock drops like this and it jumps up and then we see no building coming here, even if there's prints up here, is this a trigger towards the upside? If they didn't build down here, can it be? Think about that. Is this stock ever going to move another whatever the 19, let's call it $9? Could it ever move another $9 up without some type of building phase? I mean, anything could happen, but will it? Does that make any logical sense by understanding what a market maker's game plan is? So what you need to do is so it's very unlikely. Like, once again, anything could happen. There's no such thing as 100%, unfortunately. So if we don't see them build it in a building phase as it's coming back down, does it have any potential to get back up here? So the prints at the top don't hold much weight. We want to see building on the way. It has to. It has to, because you got to understand something. Okay, just because they bought up here, let's say they buy, we see 10 prints come in. What do 10 prints mean in the scheme of how much of a position they've built in UONE? So let's just say it hit 20. We got 10 prints at 20. Okay, do those 10 prints hold much when you really think about it? Do they hold much weight? No, they don't. Okay, they don't until we see them build again. Because I just want you to think this simple. Let's just make it this simple. Is there any way in the world this stock comes down to 10 and goes back up to 20 without them building first to get a large position in it? Is there any way that's going to happen? Or are they just going to, the market maker's just going to sit there and watch it? Just watch it. Oh, wow, look at this $10 move. It's beautiful. No, it's not how it works. You literally don't get paid to sit at a computer desk and just watch stocks. You have to make moves. So that's the easiest way, Dave, is to look what happens when it pulls back. Because all prints need to be satisfied, but do all prints in a cheap stock need to be satisfied? And a 15-minute of fame stock need to be satisfied? They don't. And what happens is, because it's a different animal, some people get caught up in the fact, well, they've had the prints up there. But those prints might have meant nothing. It might have been just a little push to get it 10 cents higher over a resistance point. So they might have shown you 10 prints at 20 just to get a little bit higher, just so people started getting in, so then they could drop it on them. It doesn't mean they were building, though. How do we know if somebody's building? How do we know if somebody is building? It's very simple. They build. They buy. You're going to see it happen. Because if a stock's going to move, let's say, forget $10. I know I'm using this as an example, but let's even say if it's a cheap stock, $3 stock's going to move $1. Is that a big move for a $3 stock? $1. We get spoiled here sometimes, and I want you to it's massive. It's gigantic. And we kind of get spoiled sometimes. That's why, I was the only one talking about UONE today. Stock moved $13. No one really was paying attention. Now, I know most of you probably weren't paying attention because there were things that were way more controllable out there. But this is, this is what I live for. A $6 stock that goes to, moves $13. But we have to understand something, is that the amount of money that was already into the stock to push it back up, even if it had prints at 19 at 1850, that doesn't mean anything. If once it falls, they don't build. Because if they don't build once it falls, is the stock going to run again? Nope. It might move again, but it's not going to run. And that's when you get these situations where you get like that, that push that comes up. And the exact question is that how do we know that prints are intended to push a stock in order for a market maker to get out? If there's no building, stock's not going anywhere. Market makers have to build for a big move. It's that simple. Okay, I know this might sound crazy to you, but a market maker trading 5,000 shares, guys, is that worth any second of their time? And I know, but you gotta understand what everything's relative. But no, it's not. 5,000 shares, it wouldn't even be worth taking the trade, because it's just, it's nothing. It's just like a stock that, let's say that you could only trade 100 shares of. Well, if you're trading 1,000 shares, there's no reason to take $100, a stock that you can only trade 100 shares of, because it's a waste of your time. That thing would have to move 10 times the amount as one that you could just trade 1,000 shares in. So by far, easiest way. Now there's other things, and that will definitely be a topic that we could do like a workshop on or something. There's other things that we can see that go into it first, but that's the easiest one. If they stop building and the stock starts moving, No good. More than likely what they're going to do. And I want you to understand another point here. Okay, if there's ask prints, let's say at 18, okay, and then there's no building going on here, okay, will they push it to 18 sometimes? Or maybe 1850? It happens because they might still want to make their money off of the prints that they had. But we know if there was no building down here and it pushes past 18 and the last prints we have are at 18, what should you be doing as a trader? What should you be doing as a trader? And somebody that sees this happening. Well, you're setting up for a short, absolutely. But unfortunately, we're talking about, for the most part, these 15-minute fame stocks, which a lot of them we can't short, which is kind of unfortunate, but it is what it is. Okay, but you better be ready to get the hell out of your long. Because once it satisfies that little bit of money that they're going to make on those last ones, if they weren't building down here, what's going to end up happening? What's the bar going to look like? Is it going to be a nice, like, little, just move down? Yeah, it's going to get real nasty. Okay, all things of, all part of just understanding what's the game plan. What are they doing? Okay, a stock does not move $10 without building. Stock does not move $5 without building, but it's all relative. A $3 stock does not move $1 without building. There's no one going out there buying 5,000 shares to make $1 on a $3 stock. It just will not happen ever. So that building part is such an important understanding of, is it a trigger? Because when is the only time a trigger can come? I know trigger by definition is volume and price action, but when really is the only time that a trigger can come? And we're going to end with this. When's the only time a trigger can come? After they built. So if there's no building, is price action and volume actually a trigger? It's not. And I'm going to leave you guys with that, because that is a strong piece of information, and 100% I would start to kind of focus on watching those things. Got to remember, these cheap stocks are a different animal, but they're just as simple. It's just you really have to understand what the game plan is behind them. Because if you're just trying to follow, especially on a cheaper stock, if you're literally just trying to follow, ask prints, pullback, moving back up, it's not going to work that way. Cheaper stocks, you need to be in their head because they don't have as much time. So they have to do things so much quicker. We don't get those nice, slow pullbacks and then the move back up. It doesn't work that way. And just anticipating and understanding what patterns are. All right, guys, make sense? I feel like this went real quick. It's 1:35 already. Any questions on today? So I know that I have a bunch more questions, and I'm going to be marking them right now, putting them into our folder, so we now have the rest for next week. All right, guys, I'll talk to everybody in the chat, and happy trading.